This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Christopher Cruden. Christopher has been in the trend following space for over 25 years. One of his starts, one of his places where he was introduced to trend following trading was at the famed shop AHL. Today, Christopher runs Insch Capital Management. A great conversation with Christopher. I hope you enjoy. Hey, listen, here's where I want to jump right in. Before we dig into your background, your current firm, and all that kind of fun stuff, I want to go back in time to something, a little nugget that I put in my first book, Trend Following. And I want to read this verbatim, and it's quoted to you. And it says, quote, "I would prefer to finish with a certain currency forecast based upon my own fundamental reading of the market and one that underpins my personal investment philosophy. The only problem is I can't tell you when this will happen or which event will be first. On that basis alone, it seems best to stay with our systematic approach," end quote. Okay, are we done our interview?
Yeah, that's about it, I'm afraid. I can't sing and you can't watch me dance, so that's about it.
That's a great line. And I did not know you when I put that in there. I just thought it was one of those nuggets I had saved. I was like, it's just such a clear... And this is going back in time, and this is not new to you. You've had this attitude and this view going back to when? When did you become this man with this view?
When I discovered that everybody else I ever met was smarter than me, I thought I'd better stick with what I knew was an unimpeachable fact. And in terms of trading, that seems to be price. Everything else is some sort of weighted opinion or subjective opinion. And when it comes right down to it, I'm not terribly comfortable with besooted soothsayers and readers of tea leaves and chicken bones. So the price is the only reality. And so, I'm happy to stand at drinks parties and give people my utterly meaningless and worthless and often wrong views. They're not really based on anything, are they? And my suspicion is nobody else's are either. It's almost like a circus trick. You watch these economists on TV, the sort of talking heads, and some of them are very entertaining, very amusing, and some of them are occasionally right. But I don't think I'd spend money on somebody's view.
Was there a point in time, a trigger as a young man, where you could have gone down the Eugene Fama route, you could have gone down the Warren Buffett route, but you didn't? So what was the pivot? Why did you not do that?
When I started off with Deanwood Reynolds years ago, and worked under the managed futures department there in Graham Capital, and Ken Tropin and all of that sort of stuff. So we met a lot of really clever guys, but many of them were, it seemed to me, systematic trend followers. When I came back to London in '88, I had a friend of a friend who was a very senior person at a firm called Singer and Friedlander, and he said, "I don't know what you do, but I know some people who do what you do," I think, as much as he understood it, because it was a very old British sort of stockbroker and that sort of environment back in the cities back then. He introduced me to Mike Adam at Adam Harding and Lueck. And it's a typical sort of British thing. Mike Adam and Marty Lueck had gone to a public school along with my wife's brothers, and, it was very, very British. I met Mike, and we decided that I would join AHL, and in those days there was AHL was AHL. I think we had a secretary called Eloise, and that's about it, really. And then Martin Hunt, who was a brilliant guy, who used to execute the trades. So I joined them, and then I got a call from Mike, and he said, "Actually, I want you to meet David." I said, "Well, that's great. I'll look forward to meet David. David Harding, this is." And I said, "Okay, fine." So I went to see David, and David was showing me on one of these huge, big CRTs that they had back then, which was color, which was kind of unusual, because we're talking sort of Pac-Man visuals here, but this one had color on it, had graphs on it, and his fingers would fly across the keyboard and another graph would come up and then it would go into a heat map. Who the hell had ever seen a heat map? I mean, this is way before PowerPoint or any of that sort of stuff. I probably sort of looked askance at all of this, but what I was thinking was, could I do this? I mean, do I understand all of this? So I was looking sort of in a sort of a questioning way. And David sort of stopped and he pushed the keyboard away. And he looked at me and he said, "Are you questioning what I'm saying?" Which I wasn't at all. I'm not in the slightest. I was in total agreement. And I said, "No, I'm not questioning what you're saying." And he said, "Good, because we have the intellectual high ground on this." Which at the time I thought was one of the most arrogant things anybody had ever said to me. And having been in the British Army, there's a lot of arrogant things that are said, but this had a new record. But I thought about that. Over the time I was with AHL, they did in fact have the intellectual high ground because they were ferociously clever people. David, Michael, and Marty, as now Aspect, ferociously clever people. And sensible people too, despite the fact that those days were all less than 30, I suppose. What I realized from that moment was that I was not going to be as clever as them. So what I decided to do was to take the one kernel of information, the one nugget from my experience with them and my smaller previous experience and much of my later experience, is that simple works. So what was the simple thing that AHL and other successful trend followers do? It is limit the amount of inputs, limit the number of parameters, and have the discipline and the conviction to follow your system. And so that's what we do. And I know that in this business people dress it up all sorts of different ways, but when it comes right down to it, that's all we do. What we do is in fact pretty simple.
Let me ask the question, your differentiating point as a trend following trader primarily, the notion of going currency only, 7 currencies. This is your primary vehicle for applying trend following, correct?
Yes.
Talk about that. That's original. That's different, isn't it?
It was at the time we did it. After AHL was bought by Mann, I moved back to New York, and there was a man there called Bob Tomiso, who was my great mentor. He was an extraordinarily important man to me in my life and development. He was a systematic trend follower. His best mate was Larry Height. So Larry was always in the office and this, that, and we're talking 91, 92, 93, around about that time. Bob's CTA number with the NSA was something like 6 or something like that. So he'd been in it for a long, long time. And we noticed that at that time there were like 4, 5, 6, 7, 8,000 CTA registrations. And we thought that the business would become overcrowded, become overpopulated. We didn't like what we saw in some of the smaller agricultural markets and the metals markets and that sort of thing. So we thought we would, the belief was, and I say it quite often, but the belief was that markets take on the personality of the participants, and if the participants are overextended, overleveraged, easily excited, inexperienced, easily spooked, this is in fact a bad market to be in. So we looked for a market that wasn't that, and we found what was those days the interbank currency markets, which were by definition a professionals market. They also have even back then, the advantage of being utterly and truly bidirectional. Stock markets clearly aren't, bond markets clearly aren't. Some futures markets you would argue that are or are not to a greater or lesser degree, but currency markets absolutely are. Truly
surfing, right?
Yeah, absolutely. It's just long dollar yen is short yen dollar. I mean, it's not hard. And there's no cost or moral view or legal impediment. It's just they were perfect markets. And so they loaned themselves, because the serial correlation that currencies seem to exhibit, to our kind of approach. So, and with the product that came out was called Kintyre, which was, in those days we traded forwards. I think there were 28 different prices, and it was in effect, it was a sort of a one-size-fits-all algorithm, believe it or not. And we're a bit surprised as people today to hear, but we never even had a price feed in the office. That's not just because Bob was cheap, but because it doesn't. Watching red numbers change to green and back again isn't a particularly sort of constructive way of spending your day, especially if your holding period is as long as it was. So, of course, now it's entirely different. Now we've got all sorts of clever gubbins, which, as you've seen with the experience with Skype for this call, I don't fully understand. But nonetheless, back then there was none of that. So we traded once a day, as we do now, and everything was pretty simple. And the program itself was very successful. It had periods that weren't successful. Then it had periods that were extremely successful. I think in the 10 years we ran the program, we probably had 2 losing years. The worst one was, I think, down to 2.54 or something like that. And other years were 30, 40, 50, 60% or more. So a very successful program.
I saw one of the comments in your newsletter quoting the Doors line, "Riders on the Storm."
Yeah.
And noting that your program is something akin to a raincoat in bad weather. But that's not necessarily true in the sense that it's not only then that you can make money. I mean, you can make money. Yeah, exactly. So why don't you expand on that idea?
Well, in fact, that particular report, Riders on the Storm, I think we put that out about 15, 18 months ago. And we have just redone it. We've just redone the numbers. We haven't changed any of the words of the report because they're still valid and hold true. But we have changed or updated the files and graphs and charts and the numbers, that sort of thing. So we were early in putting that out. The benefit of a traditional portfolio, or specifically an equities portfolio, which is what Riders on the Storm concerns itself with, is entirely, from our point of view, accidental. It's an observed fact that exists with our program, rather than an objective that we set out to produce something. We didn't set out to produce something that assisted a portfolio of equities. It just so happens that after 14 and a half years, this is an observable fact. It does. It's sort of a happy accident that it does have this effect for equity investors. But it wasn't what we set out to do.
How do you describe operationally to investors? So we have a crazy period in the market, something like October of 2008, and your portfolio starts to do well. Equities are doing bad. But why don't you walk the audience through the idea of what's happening? When equities start to go bad, people start to sell, and what operationally is happening that gives you the benefit to ride this increased volatility, this increased directional trending within your currency-only portfolio?
The answer to that question is to look at what are currency markets, and currency markets are basically markets for capital flow. So as there are seismic changes, such as a stock market declining 50% over a relatively short period of time, which they've done twice in the last decade or so, and vice versa. I mean, these are sort of big events. I don't just mean the day of the quote-unquote crash, but I mean they are seismic events. And increased M&A activity, for example, it was very popular to ascribe certain moves to that sort of thing at one stage. What else would we have? The euro coming in, for example. Everybody knew what the targets were, so that's pretty much a layup. But these are seismic events that are reflected, or best reflected, in the market most appropriate for them, which is the foreign exchange markets. We don't make those things happen. We don't make anything happen. We just hope to hold on while nothing is happening, and for the time in which something good will happen, and we know as a certain fact that it will happen.
Have you ever had and I'm saying this facetiously, have you ever had the Liechtenstein prince look at you and you say that you can't make it happen? Do some very well-heeled investors sometimes don't get that blunt, hey, I can't make it happen, but I'm still bringing you a very talented trading program with nice alpha generation, but oh, by the way, I can't force this to make money. Is that hard? That's hard for people to accept, isn't it?
It's very hard because it's sort of inhuman in a way, in the sense that people like to think they know a guy who knows something. And, it's hard if part of your presentation, or most of your presentation, is in telling them that you, in fact, are not that guy and you really don't know anything at all. So that goes down well with some and less well with others.
Well, I think it's once you start to open up and peel back the onion, so to speak, to get into the risk management, to get into the uncertainty, the volatility, how you're measuring things, how you're preventing the downside from going really down. I think it's when you start to open that up, I'm sure eyes start to perk up as well, ears perk up.
Well, I think what we make a point of trying to explain to people that our job most of the time is in not losing money. I mean, as David Harding used to say years ago, you'll always make money in this business if you don't go broke first. And that's very true. Now, what's going to make you go broke? Well, being wrong isn't going to help, but most people go broke because of leverage. So we try and stay with very small leverage relative to most currency managers, that's for sure, and survive long enough to be around for the happier days. Like Bob Tanizio used to tell define trend following as this. He says, imagine that every day you've got to go to a Manhattan and you've got a junction on a street corner and you've got your folding chair and you've got your thermos of coffee and you've got your sandwiches and greaseproof paper and you've got to sit there. Well, the morning rush hour comes in and you get jostled around, and then it goes home in the evening, get jostled around, they knock over your thermos, they step on your sandwiches, you've got fumes of cars going by all the day, the weather changes, da-da-da-da-da. And this is a terrible way to spend your life. Until one day, the parade comes by. And you don't know which direction the parade's coming from. But when it does come, you've got the best seat in the house. And that's trend following. The secret is to stay on that street corner.
When you compare, you can have that attitude in life, or you can have the other attitude in life, which to me, and I'm not trying to sound mean, but to some degree, when you're a pure, let's say, equity only buy and hold index person, index investor, you're kind of pretending that it's never going to go down. And you're very comfortable trusting the powers that be to manage those equities and keep them going up. But the objective evidence says we're going to have those 50% melts. So it's just, sometimes I want to use the word delusion. And I'm not trying to talk the trend following book up, so to speak, but I sometimes really wonder how this conversation doesn't open up more honestly to where both types of thinking can go onto the table. Because I think if more people understood the way that you think, Chris, the way that many of your peers think, I think a lot more acceptance would go down.
Yeah. Well, first of all, when we get to this point in any conversation, I would say, well, hang on a second, what are we using? Well, first of all, in my view, there's only two things you need to get right in investment management. One is benchmark selection. Always, always, always pick a benchmark you can beat. And two, time period selection. So if you, with the selection of the right time period, be it 1 year, 5 year, 1 month, 3 days, whatever it is, anybody can look like a genius. And much of asset management is based around that. So I'm not being sort of dismissive of people who say there is no tomorrow's prices, but basically these people are riding along in exactly the same way as they would say that we are riding along. They're only finessing it through benchmark selection and time period analysis. So that would be one point. The next point I'd make is most people would use, for example, in terms of asset management, a stock market index. Let's take, for example, the S&P 500. Well, the S&P 500 is in fact a trading system. It has certain rules, it has a certain number of criteria, and a certain number of rules. The most dominant rule or advantage that system has is it has the survivor bias. I mean, I haven't noticed Enron being in the S&P 500 recently, or WorldCom, or things like that. So they drop out. So it's only when they're going up are they in. But that's fine. But we also know that about 80% of equity managers who use that in particular index fail to beat it. And there are all sorts of reasons for that, and we won't beat them up on it. But, basically, if people are using that as a benchmark, they already, in my view, have surrendered to the wisdom of systematic rules-based trading, which, that we all know, they don't beat. So, from when somebody says, well, what if this happens, or what if that happens? What if it does? I don't see how what we do is terribly different from the S&P 500 or any other index that people might want to use. I haven't been in the business quite a long time. I've heard so many conversations and so many arguments that, for me at least, the evidence is pretty clear and compelling. I mean, systematic trading works better than random trading. Now, I know about the monkeys and the dartboard and this, that, and the other, but the fact of the matter is, none of them have written Shakespeare yet. Systematic, simple rules. I'm not saying it's not possible, but none of them have, to my knowledge. There have been a lot of bad books written, but the monkeys have not yet written Shakespeare.
Your simple rules have some performance drivers. The performance drivers of your G7 currency portfolio. Number one, it's driven by the number of price reversals. Number two, it's driven by the number of losing trades. And number three, it's driven by profit size and duration of winning trades. Why don't you break those three apart individually for the audience?
First of all, if we wanted to, you and I, because we have time and we're bright guys, if we wanted to develop the world's greatest trading system, it wouldn't take us long. What we'd be aiming for is a 3-to-1 win-loss, or 3-to-1 payout, risk over return, and maybe 50-50 win-loss. If we could do that, we'd have all the money in the world. I mean all of the money in the world. I don't mean large allocations, I mean all of the money in the world. We haven't done that. We have been unsuccessful in doing that. What we have got is we're about 60-40 losers over winners on average. In good times, it's better, and in bad times, it's not as good. But basically, 60-40 on win-loss. So 60% of the time, we lose on our trades. So when you look in the back of a commodity magazine, it says by our system, 98% trades winners. I'm, after 35 years, somewhat skeptical, but everybody's got to earn a living.
Hold on. You're telling me that if we buy those things in the back of the magazines that say 98% winners, you're telling me I am not going to be on easy street? Come on.
Well, I see a lot of young traders, well, not young traders, people come and say, this is the system, we'll introduce people, meet this guy, and you look at the track record and you say, well, Jesus couldn't trade that well. It's just, I do this every day and have done for 30 years or more. Nobody can do that, in my view. There are periods of time when are better or worse than others, but some of these track records you see are a function of time period analysis, benchmark selection, and leverage. So from an investor's point of view, you have to be, I would think, extremely careful and somewhat skeptical going in. In terms of the... when our system basically has 7 currencies in it, 7 times 7 minus 7 divided by 2, so there should be 21 price streams that we trade. In fact, for reasons of liquidity, obviously, we don't trade all 21. We only trade 16 of them because 16 are the ones that meet up our criteria for acceptable liquidity. Now, the computer doesn't look at them as currencies. Computers are clever things and useful things, but all it sees is a row of numbers, 16 rows of numbers, and those rows of numbers have certain characteristics and relationships with the other members of the portfolio. So, for example, if I say dollar yen to you, you immediately think of Abenomics, or if you think of euro dollar, you think, well, Europe's in recession, and Draghi, and the computer doesn't think any of that stuff. It's just numbers to the computer. So when we have these 16 rows of numbers, and internally we probably don't even refer to them as currency pairs in the conventional sense that most people do, because for us it is only price. Because price is the only reality. You look at the price, you say, well, that price is too high or that price is too low, and you might be right for all I know, but that's the good news. The bad news is it doesn't change the price. The price is the price, and so that's the main input for us. And when we make a trade, and none of this is new or radical perhaps, but with Larry Hike, for example, all trades, as he said, I think in Market Wizards one year, never made a bad trade. Well, is that an arrogant thing to say? No. What he's saying is that all trades are risk equivalent. And why are they risk equivalent? Well, because if you knew that this trade was better than that trade, you would make that trade. You just make twice as many of this trade. But we don't know that. So all trades are risk equivalent. We bet small. When we win $2.12 or 20 cents, whatever it is, depending on the time equivalent of. And when we lose a dollar. So that's where our edge is. But it's a statistical edge. It's not a knowledge edge, if you get my drift.
Absolutely. Hey, let me clarify too. When you say it's just the computer, that computer is just you and your associates automating yourselves. I mean, it's your thinking in the computer. You're telling the computer's not wildly doing things that you don't know. You're simply saying to the computer, automate our thought process. Here's our systematic thought process. Now go execute it.
That's exactly right. We don't. What we've actually done is, in our business, is just chock-a-block with cliches. Here's a cliche. In our system, for example, our losing trades are held for about 6 days on average over the 14 and a half years. Our winning trades are held for about 17, 18 days. Okay. Now, in statistical sense, what does that say? Well, what it says is you cut losses and run profits. That's what it looks like. But the idea of doing that, cutting losses and running profits, is a trader's cliche that everybody knows, but for some reason, most people can't do. But it's not hard if you set very simple rules, and that's what we have encoded. But it's not rocket science. We don't have PhDs here. I mean, I would take the view that all the best PhDs probably work for David Harding at Winton. So
he's probably the best one still, I would guess.
He is, everybody else is probably like either his cast off or reject. So why would I hire a PhD? Because what we're encoding isn't in fact that hard.
Hey, listen, you mentioned the duration of trades. Your research, you've shown, though, the number of days for a winning trade appears to matter, but it's different for the number of days for a losing trade. Why don't you explain those differences that you found out of research?
When the system is not doing well, what you see is that the period is not because we're losing bigger amounts. There are two reasons that we lose money. One, because in the main, the losing trade holding period remains the same. It is the shortening of the winning trade holding period that is one of the most noticeable statistical phenomena of losing periods. So that's the one that becomes shorter, and of course that results in a higher trading volume. And having said that, our trading volume is positively Jurassic compared to most foreign exchange people. But when in a bad period, you will find that holding period for losing trades remains approximately the same. Holding period for winning trades is foreshortened. But a bad period comes down to that for us, not because we took an absolute bath in this cross or a bath in that cross. That really doesn't happen to us in any sense.
And that's primarily, from having a rules-based approach and the most liquid of markets. This isn't like there's going to be some situation where you can't execute and get out of what you want to get out of or get into what you want to get into.
And that's why we trade what we trade, because if we were to trade, for example, and Lord knows we've looked at it 1,000 times and continually do, and even now we're looking at other currencies, but if you stick to the majors, or these in our case, these 16 crosses, there is a market for those. And more importantly, there is a price, because there is liquidity, and you can have some confidence in the price. Yes, there may or may not be a gap, but it'll be a smaller gap than many other financial instruments that you can think of. So if you were to trade the real, or I don't know, the peso or the South African rand or something like that, well, now there is another thing other than price. there's politics, there's all sorts of things. Now, we don't have the foggiest notion how to measure political risk. We don't have the foggiest notion how to measure any risk other than price. And we take the view that if you can't measure it, you can't manage it. I'm not saying that other people can't and can't do so successfully, and I wish them good luck, but I know we can't, and therefore we don't.
Chris, as we wind down, I want to ask you one kind of fun question. I know you're a pretty pragmatic guy. I think the audience can see that, so I'm sure you're not sitting around wishing or hoping. But business would be even more interesting if one day that the powers that be in Europe decided that the euro needed to go back to what it was before the euro. That would give more opportunities, would it not?
Prior to the introduction of the euro, we only traded the Deutschmark as a proxy for Europe, and that has to do with correlation or changing correlation. So pre-euro, you could have theoretically 6 or 7 tradable currencies, but in times of great stress or difficulty, you'd actually end up with one position 7 times as large as you hoped it would be. Now, to avoid that, we only ever trade Deutschmark. If it went back to pre-euro currency, so lira and guilder and all that sort of thing, then we would probably take the same view that there is one European currency, and that would probably be the Deutschmark. In other words, we would reverse the decisions we took when the euro was coming in. But they certainly would be exciting and potentially profitable times.
It's interesting perspective, though, that essentially you were already trading the euro before the euro.
I think we were, and I think many people were. I mean, as I say, what we do is not unique or clever. I mean, some people might think it is. I don't know, but to me, it's pretty obvious. This is not hard. I mean, you can discount a lot of things very quickly, or you can go on some sort of academic scavenger hunt and convince yourself that you're Einstein, which is fine. It's a big church.
I miss living in London. I miss the dry sarcasm, the academic scavenger hunt. I miss it.
Well, as I say, this is not hard. What is hard is doing it.
Yeah.
It's hard to come in and see that you've got another reversal, and you've got another reversal, and you've got another reversal. That's hard. But the reason that it's worthwhile is because when it does go your way, it goes like a train. And the reason that we take things like reversals and this, that, and the other, and we get whipsawed, which is a sort of no word of trend following, but it's because of what we know is, and I think maybe some investors don't know this, but if you lose a dollar, it's harder to make back that lost dollar than it is to make a new dollar because of volatility drag. For example, if I lose 25% in the stock market, I don't need to make 25% to get flat. I've got to make 33 1/3% to get flat. That volatility drag is really punitive. It is an additional price for being wrong. The reward for being right is not as great as the reward or the penalty for being wrong.
And I guess with clients also, the reward for being right is, well, you're not allowed to be wrong anymore. Just keep being right all the time.
Well, a rising tide lifts all boats. And, I think everybody, yourself especially, and myself and many others who do what we do the way we do it, we've seen this before, and if we live long enough, we'll see it again. A lot of people get it. We've got a whole generation now of asset managers, or young guns who've come in and seen the stock market double.
Yeah, and that's their starting point. I mean, think about how many young people are essentially got started, young traders, professionals, and got started in early 2009, and their frame of reference is simply straight up.
Absolutely. Buy stocks, they go up.
Yeah.
Everybody knows that. We actually saw the similar sort of thing in the 90s, didn't we?
Absolutely.
And you find people who will say to you, they talk as if it's a God-given right to make, back in those times, 20% a year in the stock market. Hello?
I still remember the NASDAQ, what was it, 100% in 1999 it went up. It was crazy.
Absolutely. Yeah. Absolutely. And up it goes. And on average, you're making these huge returns. It's easy. Markets don't exist to make you rich. They're not here for your enrichment or entertainment. They're here to teach you humility. And that's what they do better than anything else that I've ever experienced. They teach you humility. After periods such as this, we forget that markets halved. Why? Markets are doubled. Isn't it brilliant? Let's talk about, they're like a bad trader. You do just walk through a trading room, and the trader will come and tell you, well, you do so-and-so, that's great, da-da. But let me tell you, I bought the yen when it was da-da, now it's up. So yeah, okay, so you're telling me you're actually good trades. One of the parts that's missing from the conversation is your bad trades.
So, you're sitting here talking about humility, and there's plenty of young traders out there thinking, hold on, but really what's going on in the office, Chris? You guys are like all jacked up on coffee, and there's a huge adrenaline rush, and there's screens flashing, and everything's popping, and there's bells going off, and you guys are just going at it all day long. I mean, you're just not telling the truth, Chris, about how it really happens at the office.
Well, this place is like a graveyard. We don't allow anybody to watch screens. I mean, we trade once a day at London 1 p.m. and after we make those trades, we're done for the day. That's it.
But that's not a cavalier statement. That's just an objective, factual statement. But as we've been talking this whole conversation, there's a lot of depth of understanding that goes in to allow you to make that kind of objective statement. But you're not trying to be arrogant or like, hey, we only trade at 1 p.m. You're just saying this is a matter of fact. This is what we do operationally based on our system.
Yeah, well, it's the deepest, most liquid time for FX markets, point one. And point two is, again, it's something that we have to do it that way because that makes it measurable. If we came in and decided, for whatever reason, randomness would be a reason, to trade at a different time every day, well, that would be kind of more difficult to measure. So it's not arrogance. In terms of arrogance, I yield to no man, but there is a reason that we do things the way we do things, and I wouldn't for a moment pretend that other people don't have good reasons or better reasons to do things differently. As I say, good luck to them.
Hey, Chris, you guys put out a lot of great research, a lot of pieces of writing, and I know you talked about something I've not had a chance to see yet. Hopefully we can talk again here in the months to come. But where can people go to check out your firm, see some of the papers that you've written, some of the information you've put out? Where can people go?
Well, our website is www.inschinvest. Now, Insch is spelt with a C, so it's INSCH invest.com. Our head of research is Pernod Schneider, and although my name goes on it, and I take partial credit for what she does. In fact, most of the donkey work is done by Pernod and Rivaldi Kwan in London, and Philip Balich, who's also here in Lugano with us.
Is that more of the humility? What you refer to that the trading system and the efforts is the donkey work? I don't know if I've heard that one before, but I love it.
Well, there might be somebody who has a sort of a spark of genius, like the Sistine Chapel, the spark from the finger, and I would credit myself as occasionally I come up with a good idea, but rather like trades, most of my ideas are bad ideas. They have to be researched and tested, and Pernod, Rivaldi, and Philip do that. And so, again, exactly the same as I just said about a trader. Most of the things I think of fail to pass scrutiny in the end. But some of the research reports that do come out, we are often complimented on it. And the great thing about being us is that we're beholden to nobody. I don't have to trade through anybody. I don't have to do anything for anybody or to anybody. And I really don't care what anybody might say. So on that basis, we are pretty free in looking at what we would look at and concluding whatever it is that we conclude.
I think for the audience out there, whether it might be a potential new investor to your firm or an established investor or just a young person looking to learn from you and your associates and your work, go look at Chris's track record. Just go look at the monthly ups and downs, look at the annual totals, just look at everything and observe that it's not all black ink. There's some red ink in there. And I think that's what for me, I've always taken that when you look at a trend following track record and you look at that red ink, if you don't see the red ink, there's trouble. If there's no red ink, it's not trend following. You're
absolutely, completely correct about that. And that's what I tried to allude to in the morning. I see some earlier in our conversation, I see some track records, I look at it and sort of, with the sort of the one blink test, fail. I don't think so.
Yeah.
I don't think so. And I'd hate to be cynical about this, but going back into the sort of olden days, if people or clients are making allocations to trend followers, guess what? You see a hell of a lot more people describe themselves as trend followers. And extend that to managed futures. If managed futures does really well, guess what? Megabank PLC or whatever, they produce a managed futures fund. Do they know anything about it? Not a bit. But that's okay because they're paid on assets under management. Yeah. Do you see what I mean? If there is a demand, supply and demand, the supply will rise to meet the demand, and that's true of investment management. So if, for example, trend followers over the next 3, 4, 5 years do really, really well, you'll see a lot of people rebadging themselves as trend followers. It's to be expected. It's obvious.
As you mentioned that quick peak idea, I always say, and I've said this before, if you see a track record, and for example, I can think of 2 famous track records in the last 15 years, Bernard Madoff's, which was a scam, and Long-Term Capital Management's, which was just a bad process. But both of them showed you that consistent 1 or 2% a month. And so to me, it's like if you see, and this might sound crazy to investors, if you see a track record that shows plus 1% for every month of the year, that scares me more than a track record that might show a minus 7% or a minus 8% a month. It's the plus 1% every month that should scare the bejesus out of you.
Me too, because it is simply not doable in my experience. These, as I say, these places aren't there for your enrichment, and somebody who's going to make 1.25% a month and has done for the last 42 months, and I'm sorry, fill your boots, write the check, but for me, no.
When you see that track record, there's something else going on besides the track record. The track record is funky, to say the least.
Yeah, but there's a lot of it about.
Yeah. Hey, Chris, listen, great conversation. And I want people to go check out your website, check out your writings. And like I said, hopefully we can talk again in the future. And like I said, I go back to reading that opening quote that I put in my book. And my gosh, I probably found that 2002, 2003 when I first saw it. So I pulled it up today. I was like, I got to pull that quote up that I put in my book from Chris. So.
Well, since those days, which is a long time, it's got to be well over 10 years, I can assure you we haven't learned any more new things, but we've learned more about what we don't know. That's for sure.
Well, as you say with humility, there's another humility statement right there. Hey, Chris, I appreciate you coming on today, and thank you again.
Thank you very much indeed, Michael. Thank you. Bye-bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.